watched my last video, I was talking about the state of buying this year in 2020. And the first point that I made of if you should be buying is the state of interest rates. Interest rates have dropped about 1% since last year. It may be a little bit more now, but let's use 1% as our basis to demonstrate the effect that it has on buying real estate and owning real estate. So this is a twofold effect where you have option one, where you can achieve a higher return for the same price that you would be buying at. And option two is you can achieve the same return at a higher price. So option one is higher return, same price. Option two is same return, higher price. Let's look at option one, where we're achieving a higher return for the same purchase price. So for this example, let's say we're buying $1.5 million property with $1 million loan, which is a 67% loan to value LTV loan, which is pretty reasonable in today's market. Let's say we're buying a 5% cap rate. Cap rate equals your net operating income over your purchase price. So to achieve 5% at $1.5 million, that means your net operating income is $75,000. A year ago, when interest rates were 4%, your annual mortgage payment was $40,000 on $1 million loan, 4%. So at $40,000, when your cash flow equals your NOI, your net operating income minus your loan payment, you're left with $35,000 at the end of the year. Now, because interest rates have dropped 1%, your annual mortgage payment becomes $30,000, your cash flow becomes $45,000, which is a $10,000 increase and a 28% increase in return. Just because interest rates have dropped 1%, your increase goes up 30%, approximately 30% higher cash flow with a lower interest rate. Now let's look at option two, where we're achieving the same return at a higher price. Let's use the example from option one, where a 4% interest rate on $1 million loan creates a $40,000 annual payment. So to get the same $40,000 annual payment at 3% means that your loan can now be $1.33 million. So 3% times 1.33 million is a $40,000 annual payment. What does this mean? Either you can buy the same building at a higher price, or you can buy a bigger building in order to achieve the same return, the same cash flow, where your NOI minus your debt service, your annual loan payment, equals your cash flow. So at this lower interest rate, you can get a bigger loan, pay more for the same building, or buy a bigger building. So the impact of lower interest rates is an increase in your buying power. And how does this show? Is you can either achieve a higher return at a lower interest rate, or buy a bigger building, or pay more for the same building and still achieve the same return that you would have at a higher interest rate. So lower interest rates leads to greater buying power because your loan payment is less, there's more room, there's more margin to still get cash flow or get higher cash flow on your properties. Whether you are currently looking to buy property and take out a new loan, or you own property and could potentially refinance at a lower interest rate, I strongly advise you to investigate this, take a deeper dive, and see the impact that a lower interest rate can have on your bottom line, on the income that the property produces, and your cash flow.